What's going on, guys? Welcome back to the channel. Matthew Min is here. Today's video, we're going to talk about ibonds, a specific type of bond that is designed to beat inflation. So if you want to park your cash in a safe, risk-free place and still earn extremely impressive interest rates, mostly due to the current economic environment we're in, then ibonds could be a great investment option for you. So first things first, we have a disclaimer. I'm not a financial advisor. These are just my opinions. It's up to you guys to do your research and determine the best route moving forward for you. So in this video, we're going to talk about what an ibond is, how the rate of return is calculated, because it does vary. We're going to talk about why ibonds are currently a really good investment and offering a pretty high return with zero risk. We're going to look at an example that shows you specifically why ibonds beat out the interest rate of a savings account or CDs, certificates of deposit, that your banks may offer. We're going to go over how you can buy bonds, how much you can buy. We're going to talk about taxes involved with bonds. And then lastly, we're going to talk about who this would apply to. You know, who could benefit from bonds, because it's not everybody. But yeah, let's get right into the video. Now, some of you may be wondering, what exactly is an ibond? Well, an ibond is a specific type of bond or savings bond issued by the US government. These bonds are to help protect your money and beat the current rate of inflation. They use two forms of interest. They use a fixed rate of interest, and they also use a variable interest rate that is changed twice per year. And to determine that number, they use the CPI, or Consumer Price Index, the inflation results over the previous 6 months. So the great thing about an ibond is it's always going to beat the rate of inflation. So keeping your money in an ibond is always going to be a better option than keeping your money stuffed under your pillow. So the question is how is the rate of return for your bond calculated? Well, as I've already mentioned, there's two parts to it. There's the fixed rate, and then there's the variable interest rate that goes off of inflation. Now, the fixed rate is very easy. Whatever the fixed rate is at the time when you purchase the bond is going to stay with you for the life of the bond. And then the variable interest rate is going to change every 6 months. There's a chance that it doesn't change, but it's rare. And it's based off of the Consumer Pricing Index. If you want to see the exact calculation and how that's determined, you can go to the treasurydirect.gov website, and it explains it right here, as you can see. Another cool thing it shows when your interest rate will vary based on the month that you purchase your bond. So if you bought it in February, you're going to get a change for new rates in February and in August, because every 6 months it's going to change. The fixed rate doesn't, however, the variable interest rate does. You can also look at previous rates in the past if you'd like to look at. And as you can see, in 2021, 2020, interest rates are extremely low. So the fixed rate is not actually providing any benefit. However, in the past, they did have some interest, although pretty weak. And now the big question is, how do we have a 7% return rate on bonds? That's pretty impressive. Well, if you go to the CPI website and you look at the current inflation, as you can see this morning, the CPI data came out, and month over month, we had an increase in inflation of 0.9%, which was actually 50% higher than expectations, which is crazy. And also, year over year, we're at 6.2% inflation over the last 12 months. That's crazy. So as you can see, if you were to get a 4% raise this year, even though you got a 4% raise, which you might think is pretty significant, you technically are losing 2 to 3% money versus prior year, because everything around you is actually going up in price. Now, before we go into my favorite thing, which is looking at the actual numbers in Excel, what we're going to do is we need to quickly discuss how to buy them, how much you can buy on a yearly basis, and when it comes time to sell them, can you actually sell them? What are the penalties involved with selling them? And are there any timelines we need to be aware of? Well, first things first, to buy them, you go to treasurydirect.gov. You're going to create an account and then follow the instructions. You'll be able to purchase them. Pretty self-explanatory to anyone that's a little bit computer savvy. Now, when it comes time to, you already have your bond and you want to sell it, if you're within the first 12 months, you cannot sell it. So you don't want to put money in that you're going to need in the next 6 months. You're not allowed to pull out for the first 12 months. Now, when it comes to year 1 to 5, you can pull out. I would always say never pull out unless you absolutely have to. You do receive a small penalty. The penalty is, since you accrue interest on a monthly basis, 3 of those months they're going to take away. I'm going to show you a specific example of that to show you how it applies when comparing to a savings account or a CD or something like that. So just keep in mind, from year 1 to 5, you lose 3 months of interest when you pull out. Anything after year 5, you don't pay any penalties. And the beauty of it is when we get into taxes. So taxes, you only pay federal income tax. You don't pay state income tax. For someone like me that lives in New York, and I could say a lot of things about New York, but I'm not gonna, this is very beneficial to someone like me. If you live in California, same thing. If you live in Florida, you don't have a state income tax, it's not really gonna benefit you. Another cool thing is if you're using the money towards college expenses or education, you actually don't even have to pay the federal income tax. However, there are better alternatives when it comes to saving for education, such as like a 529 plan or something like that. But also remember, I am not a tax accountant. My accountant actually watches these videos, so I'm sure he's gonna say that I said something wrong. So if I made any mistakes, just let me know in the comments down below. I'm sorry. But now that we've talked about how you buy and sell them, let's get into an example and look at the actual investment and the returns that are possible. Okay, so what I've created right here is just a small little spreadsheet that uses the current interest rate of a high yield savings account, such as Ally. I've also included an Ally CD, and then I've included the ibond. So I'm using the current interest rates of those specifically. Now we can put in any initial investment. You can only invest up to $10,000 if you're buying an ibond. You can get an additional $5,000 if using your tax return, but for this example, we're not even going to reach the maximum. We're just going to put in $5,000. So when I put in $5,000, if we decide to go 12 months without pulling out any money, at the end, we're going to have $5,025. I should add a little disclaimer here that in the ibond calculation, I have the interest compounding monthly. However, the interest on an ibond actually compounds semi-annually. So you're going to accrue interest on a monthly basis. However, that interest does not add into your principal value of the bond when it comes to creating new interest until every 6 months. So after you've accrued interest for 6 months, they take that, they apply it to the principal value of your bond, and then now you're making interest off of all that. So the numbers are slightly different, but for ease of math, we're doing this. So when we look at the CD, we have a 0.55% yearly interest rate, and we ended up with $5,027. If we had invested in a bond and we pulled out right at the 1 year mark, remember, you can pull out at a year, you just lose 3 months of interest. So in the calculation here, you can see that I have the initial value, and then I take the multiplication of 3 months less than the total length of holding the bond times the rate, and we end up with $5,267. So if you had done this for 1 year, you would have significantly more money when using an ibond versus savings. We could change this. Let's go ahead and put in $10,000. So this is the maximum if you're doing yearly per individual. If you're married, you could do 10,000 a piece, but we're pretending to be an individual here. We end up making $50 off Ally, $55 with their CD, and then $500 using their ibond. Now we can change the number of months, which is, will make a significant impact. Remember, at the 5 year mark, you don't face a penalty. So we're gonna do less than that. We're gonna do 3 years. We'll do 36 months, and we end up getting, almost $12,000 3 years later, whereas we've only made $150 or $165 if we had kept our money in the savings account. So looking at these examples, you could see that with high inflation, like the current environment that we're in, ibonds really shine when compared to a safe alternative for your savings. Just remember, you cannot pull out within 1 year. So don't take your emergency fund and put it into ibonds. So who do I think could benefit from bonds? Well, I think someone that already has an emergency fund of at least 6 months, all expenses paid. I don't think you should take your emergency fund, as I've already said, and put it into ibonds because you could need it in less than a year. However, if you're still trying to save cash, and you want to have extremely low risk, actually zero risk technically, then ibonds are a great option if you've already covered your emergency fund. So you're not going to need that money for at least 1 year. You're golden. Perfect. I think that bonds are a good addition to someone that is already significantly exposed to the market. So if you have a lot of securities, you're already well established in your index funds, you've got your crypto, you're well diversified, maybe you have other investments such as real estate, and you want to have a certain portion of your portfolio be cash. Maybe you want it to be 10% of your entire portfolio. If you have a significant net worth, $1 million or, obviously less or significantly more, you may want to have a lot of cash and you want to put whatever you can into bonds to earn a higher interest rate versus in just a savings account where you're not earning as much. Obviously, you have to just factor in the limitations of how much you can do per year. So in summary, for me specifically, I actually don't own any bonds. And the big reason for that is my emergency fund, I was significantly above a 6 month. And I took all that excess money and I actually put it into Q Yield and Newsy. I've talked about that in recent videos. I'll have a link down in the description below. So I took a little bit more risky of a position with my excess cash and put it into those funds. However, now that I'm working on building back up my cash reserves and I already have a lot of money in Q Yield and NUSI, I probably am going to start putting a little bit of money into bonds once I reach the specific mark that I'm aiming for in terms of my actual savings. So I'm not there yet, so I can't do anything yet. But once I get a little bit more exposure to the markets, then I am going to put a little bit more money into bonds because I want to have a bit more cash on hand available if ever needed. So all in all, I think I-bonds are a fantastic investment right now due to high inflation. If inflation all of a sudden inflects downward, then it's not going to be as good of an investment. You're still going to have zero risk, but your return is going to be significantly lower. So right now, awesome investment. Now, if you found this video beneficial in any way, make sure you smash the like button down below. Let me know what you thought in the comments. Make sure you're subscribed to the channel. We do videos every single Thursday at 3:15 p.m. Eastern Time. And I hope to see you guys in the next one. Take care.